Good evening. Okay, we wanted to spend a little bit of time talking about another type of very useful trust in specific instances. To be really honest with you, it's a lot more fun to talk about than it is to go and do. Okay, so there are good reasons for this trust. There are wonderful tax benefits with this trust. But once again, I talk to 100 people to every one that really wants to do one. But I want you to understand how this works. They're called charitable remainder trusts. Okay, charitable remainder trust. There's two types. One is called a CRT, which is charitable remainder annuity trust, and the other one's called a CRUT, charitable remainder unity trust. Okay, and so a charitable remainder trust has a specific purpose, and the specific purpose is to help us to not only obtain a charitable desire, which is always a good thing to have if you're going to have a charitable trust, but it also gives us the chance to be able to sell a highly appreciated asset and not have to pay the capital gains tax on it. Okay. So this is how it works. We create this special type of a trust, a charitable remainder trust. And whether it be a charitable remainder annuity trust or a unity trust, it doesn't matter. They're both going to work similar in many ways. We then have to we're going to go ahead and put an asset, such as maybe a 200-acre farm that Grandma Joe, 150 years ago paid $100 for, and now is worth $14 million. If we were to sell that, we'd have to pay a tax, capital gains tax, on $14 million because it really doesn't have any type of basis at all. And you figure minimum capital gains tax is going to be about 23-25%. It's probably going to be more in this particular case. So that's a lot of money. We're going to have to be paying $5 million in taxes. We don't want to pay that. So we put it into this charitable remainder trust. Now, in the charitable remainder trust, to start off with, we have a special trustee. This trustee has one job, and that is to sell that piece of property and put the money somewhere else. A lot of times we put it into an annuity, but we don't have to do that. So the deal is that they go ahead and sell the property. Because the beneficiary of the trust is a charity, we don't have to pay tax on this sale. But we also are a little bit controlled on how we use it. So the government wants to make sure that we are going to pay our tax on at least part of this, and so they're going to require us to take out at least 6% of the estate every year. Okay, they're going to see this as income, and they will charge us tax on that 6%. Some people take 12%. You can't take 5%. You have to take at least 6%. So the deal is they're going to go ahead and charge you tax on what you take out. Now, why do they let us sell this property and not pay tax on the sale? Why do they allow us to do this? Well, the reason is because they know that a church or a charity will be able to do more good with the money than the government can. Somebody came up with a report some time ago, and I can't remember, it was so long ago I saw this report, but the report had something that said that if a charity received the monies, that somewhere between 80 and 100% of the money that they receive is going to be used to benefit the people that are in need, the poor, the homeless, those that need medical needs, all this type of thing. And they can do it in a much more efficient way, because if the government gets it, only 51% of the monies that they receive to do charitable work is actually used for the charity. The other 49% is actually used for administration. So they figure, why not let them take care of this? They'll be able to take care of twice as many problems as we can with the same money, and that's why they allow us to do this. So now what happens, this special trustee sold the property, put it into an annuity, or put it into investments, or bought a new business with it, whatever it is, but they went ahead and did something with it, and they stepped down. And now the person that owned that property in the first place can step forward and now can be the trustee of this charitable remainder trust. And what are they going to do? The same kind of investments they would have done if they had it in their own name. So now there are some people that use some of the money and they actually buy a life insurance policy to replace the $14 million that the kids are now no longer going to get because the beneficiary of the trust is the church or some kind of charity. And so they'll use some of it for a single payment premium for a life insurance policy. So the $14 million is still going to go to the kids. They still have, of the $14 million, $10 million left after paying for that premium to go ahead and do investments with, to be able to buy other properties, to do development with. And as they're doing it, they're able to continue to get some charitable benefits. Now, another benefit you get is because you put this into a charitable remainder trust, the person that did it gets a current charitable tax deduction on their tax returns. And depending on how old they are and how long they're going to be keeping it, if they did this at 32, which means their life is going to be another 70 years, the amount of charitable gift is going to be smaller. If they did it when they were 87 and their life expectancy is only another 5 years, they're going to get a much larger charitable tax deduction. And so by doing this, you get a current tax deduction, you get to save on the capital gains tax, you get to control it after the first sale, and you only have to pay tax on that money that you have to take out every year. Now, this is another thing you can do. You can actually put a clause in that says, hold my 6%. I'll pay tax on it, but you hold it, keep investing it with all the other monies, and don't give it to me until later. So the deal is it could be you may not have to pay tax on it until you take it out, or you may be able to have to pay tax as it is attributed to you. But the deal is you can probably save taxes by leaving it in there and having it come out later. The charitable remainder trust is dependent upon, it was going to continue for the lifetime of an individual. It's usually the person that had the property that put it in there, but it can also you can add to that their spouse, so it can go longer, and you can add to that their children, so it can go even longer. Now you can imagine if they're going to go ahead and have it, depending on the children's ages, their current charitable tax deduction is going to be pretty small, okay, because it's going to be 100 years before the charity actually gets something. And they don't worry too much, to be really honest with you. They don't worry too much about whether you use it all up in that 100 years before the charity ever gets it. Okay, we usually try to make sure there's something left in the end for the charity, but there have been times where it's actually all been used up with those distributions before the charity ever gets anything. And that is something that we can work with a charitable remainder trust. So if you have a charitable intent, if you have an asset that has high capital gain on it, if you need a current charitable deduction, but you want to keep control of the asset, then this is something you can come and talk to us about, and we can help you put this type of a plan into play. So we'll look forward to talking to you, and have a good evening.